On April 28, 1942, a broker on the floor of the New York Stock Exchange watched the Dow Jones Industrial Average print 92.92, the lowest number anyone alive had ever seen. Trading seats that once sold for $600,000 were changing hands for $17,000. Dividend yields hit 9.5%. This was not because companies were being generous, but because nobody wanted to own them. France had fallen. Pearl Harbor was still smoldering. Singapore had surrendered. German U-boats were sinking American tankers within sight of the Atlantic coast. And the smart money, the old money, the careful money, was selling everything. Not next quarter, not gradually, but now. That broker faced the same question you are asking right now. As American and Israeli bombs fall on Iran, Iranian missiles strike the Gulf states, the Strait of Hormuz is shut down, and war grinds on in Ukraine, when the world catches fire, what do you actually own that survives? Before we go further, nothing in this video is financial advice. This channel examines history. What you do with it is your decision. Do your own research. We are historians here, not brokers. The official story of wartime investing is simple. Buy bonds, support your country, and the government will protect you. 85 million Americans bought that story. They purchased $185 billion in war bonds. The Series E sold at 75 cents on the dollar, promising a 2.9% annual return over 10 years. The Treasury Department called it the greatest investment on earth. Hollywood stars sold them at rallies. Factory workers bought them through payroll deductions. School children collected quarters in stamp books. History, however, tells a completely different story. According to a 2023 study by economist Brunette Hilton-Gurmsky, published through the National Bureau of Economic Research, a Series E bond purchased in June of 1944 delivered a cumulative real return of 3%. For most redemption dates after 1946, the real loss ranged from 16% to 22%. Two post-war inflation spikes, 14% in 1947 and nearly 8% in 1948, devoured the promised returns before the ink was dry. A factory worker who bought bonds through payroll deduction from 1943 to 1945 would have had 13% less real purchasing power a decade later than the day he started buying. The political fallout was measurable. The same NBER study found that counties where more Americans had purchased war bonds shifted disproportionately toward the Republican Party in the 1950s. The betrayal was quiet but deep. Nobody called it a default, but the families who trusted the government's promise discovered that inflation is a default, just one without a headline. The greatest investment on earth lost money, not because the government defaulted, but because it inflated. The Federal Reserve deliberately pegged interest rates at artificially low levels from 1942 through 1951, a policy economists call financial repression. Using rising prices to shrink the real value of government debt, the bondholders paid for the war twice, once with their money and once with their purchasing power. Now consider the stock market. That same broker who watched the Dow hit its wartime low in April of 1942, if he had bought at that moment of maximum despair and held through VJ Day, his total return would have exceeded 100%. 100%. The market's turning point tracked the battlefield's turning point with eerie precision. After Midway in June of 1942, after El Alamein that October, and after Stalingrad that winter, the Dow never looked back. Defense stocks led the way. Boeing built the B-17 and B-29. General Motors made tanks and aircraft engines. Henry Kaiser, a mid-sized contractor before the war, built nearly 1,500 cargo ships and 50 escort carriers. He died in 1967, controlling an industrial empire. Andrew Higgins went from 75 employees in 1938 to building the landing craft that carried Allied troops onto every beach in the Pacific and at Normandy. Eisenhower called him the man who won the war for us. But here is the uncomfortable part of the story, the part that matters if you are asking this question because you are worried about the losing side, not the winning one. Equities work brilliantly in America because America won. What happened to the people who lost? Germany's answer is the most thoroughly documented case in history, and it reveals a rule so consistent it deserves a name. Call it the 14-1 rule. On June 20th, 1948, a team led by a 26-year-old American economist named Edward Tenenbaum executed one of the most consequential financial events of the 20th century from a set of barracks in Rothwesten near Kassel. Every German citizen received 40 Deutsche Marks, then 20 more. Bank savings were converted at roughly 10 Reichmarks to 1 Deutsche Mark, with the effective rate settling at 6.5 new marks for every 100 old ones, a 93.5% loss overnight. But stockholders in real companies, companies that made things, employed people, and owned factories, fared dramatically differently. When the Allies broke up IG Farben into BASF, Bayer, and Hoechst under U.S. High Commissioner Law No. 35 in August of 1950, shareholders received stock in every successor company. For every 1,000 Reichmarks of IG Farben stock, holders received approximately 915 Deutsche Marks in successor shares, an effective conversion rate of nearly 1.1 compared to the 6.5 to 100 rate for cash. Equity holders preserved 14 times more wealth than cash holders through the same national catastrophe. 14.1. The mechanism is critical. The Reichmark died because it was a government promise, and the government that made the promise no longer existed, but a factory still stood, a patent still worked, a customer relationship still held. IG Farben's chemistry did not care what currency the invoice was written in. The productive asset survived because its value came from what it could do, not from what a government stamped on a piece of paper. The same pattern appeared in Japan with devastating clarity. The yen, which had traded at roughly 4 to the dollar in the early 1940s, was fixed at 360 to the dollar in 1949, a decline of over 99%. Consumer prices rose more than 360% in 1946 alone. The government froze bank deposits in February of that year, effectively confiscating liquid savings from every citizen in the country. The great Zaibatsu, Mitsui, Mitsubishi, Sumitomo, Yasuda were broken apart by American occupation authorities. Assets of 56 individual family members were frozen, but complete dissolution never happened. By 1948, Washington's priorities had shifted from punishing Japan to rebuilding it against communism. The former Zaibatsu reassembled as Keiretsu. Family control was permanently broken, but the productive capacity, the factories, the shipping lines, and the trading networks survived under new ownership structures, and the land survived. This is the detail that matters most for anyone worried about physical destruction. American firebombing destroyed 16 square miles of Tokyo in a single night, March 9, 1945. 80,000 to 100,000 people died in hours. But the land registration system endured. Property records survived. People who owned urban lots in Tokyo, even lots where nothing but ash remained, retained legal title to ground that would eventually become among the most valuable real estate on earth. Italy followed the same script. The lira went from 19 to the dollar in 1927 to 6.25 by 1949, a 97% devaluation. Cash was annihilated, but the Agnelli family kept fiat intact through a layered holding company called IFI, established in 1927, years before the war. Johnny Agnelli served as an officer on the Axis Eastern Front, then became a liaison to American troops after the 1943 armistice. The political pivot was seamless. At its peak, the Agnelli family controlled assets equal to over 4% of Italy's entire economic output. The pattern repeated decades later. During Yugoslavia's civil war in the early 1990s, monthly inflation peaked at 313 million% in January of 1994. The dinar became wallpaper, but researcher James Lyon documented that the price of burek, a common street pastry, remained stable at approximately 1 Deutsche Mark throughout the entire hyperinflation. Hard foreign currency maintained purchasing power while the domestic currency became confetti. The instrument was different, but the mechanism was identical to post-war Germany. Now the question you are actually asking, could it happen here? Could American assets be confiscated, frozen, inflated away, or destroyed in a future conflict? The honest answer is that it has already happened twice in living memory. Executive Order 62102 in 1933 seized private gold under the Trading with the Enemy Act of 1917, a wartime statute repurposed for peacetime. Americans were given less than a month to surrender their coins and bullion at $20.67 per ounce. Roosevelt then revalued gold to $35. pocketing the difference for the Treasury. Compliance was low. Milton Friedman estimated only 1 in 4 Americans surrendered their gold, but the legal precedent was set. Executive Order 9066 in 1942 forced 122,000 Japanese Americans from their homes with less than 2 weeks' notice. Properties were sold at fire sale prices. One 45-room hotel went for $2,500. Total property losses reached an estimated $1.3 billion in 1983 valuations. Congress did not formally apologize until 1988. The mechanisms of confiscation have changed, but they have not disappeared. Today, the Foreign Account Tax Compliance Act, FATCA, requires over 110 countries to report American-held accounts to the IRS. Many foreign banks now refuse to open accounts for Americans at all. This functions as a capital control under the guise of tax enforcement. You do not need a confiscation order when you can simply make it impossible to move money across borders. So what actually worked? History across every conflict studied, from the Civil War through the Second World War through Ukraine, points to 4 strategies that real people used with documented results. First, equity in productive enterprises held through the crisis. The Quandt family of Germany offered battery production services to the British occupation authorities within weeks of surrender. Herbert Quandt received an operating permit despite his wartime record. In 1959, he increased the family's stake in BMW to 50%, saving the company from a Daimler-Benz takeover. Today, his heirs own over 40% of BMW. Friedrich Flick, convicted at Nuremberg and sentenced to 7 years, served 3, then used the proceeds from his remaining Ruhr holdings to buy devastated industrial concerns at fractions of their true value. He acquired a 40% stake in Daimler-Benz and became West Germany's richest man by 1970. Alfred Krupp was convicted of slave labor and sentenced to 12 years with total property forfeiture. On January 31, 1951, U.S. High Commissioner John J. McCloy commuted the sentence and restored the property. By 1953, Krupp had resumed sole proprietorship of his empire. The pattern was not luck, it was the Cold War. Washington needed German industry rebuilt against the Soviets, and every industrialist who owned something essential was rehabilitated. The mechanism was not stock picking, it was owning a piece of something that the post-war world still needed. The modern equivalent is the same: ownership of productive businesses, ideally ones whose output remains essential regardless of who wins or loses. Not paper claims, not options, not leveraged instruments, equity in things that make things. Second, gold held outside the banking system, invisible to government seizure. On the black market in post-war Germany, gold commanded enormous premiums over its frozen official price. American cigarettes traded at 6 to 20 Reichmarks each, a de facto parallel currency. But gold was the only asset that held value across borders, across currencies, and across occupations. The critical word is outside. Frederick Barber Campbell stored 5,000 troy ounces at Chase National Bank. The government seized every ounce. The families who survived kept their gold where no institution could reach it. Today, physical gold stored at home or in a private non-bank vault uses the same mechanism. If the value depends on an institution honoring a promise, it is not outside the system, it is the system. Third, geographic diversification established before the crisis. Britain's Operation Fish, the largest physical transfer of wealth in history, moved approximately 100 tons of gold and securities worth over $200 billion in today's dollars from London to vaults in Ottawa and beneath Montreal's Sun Life building. Not a single ingot was lost. The families who preserved multi-generational wealth, like the Vesti and the Grosvenors, had already established offshore structures before the first bomb fell. The modern equivalent is harder. FATCA has made foreign accounts visible, but self-custody Bitcoin exists in no jurisdiction. A memorized 12-word seed phrase carries unlimited value across any border with zero physical weight. When Russia invaded Ukraine in February of 2022, the central bank froze electronic transfers and ATMs ran dry. One Ukrainian man crossed the Polish border carrying nothing but a USB drive with his life savings in Bitcoin, invisible to every checkpoint. That is the same mechanism as Operation Fish. The instrument changed, but the principle did not. Fourth, land, not as a speculation, but as a foundation. In the American South after the Civil War, The Confederacy's financial destruction was total. 9,000% inflation. Every Confederate dollar was worthless at surrender. The largest wealth destruction was emancipation itself, which eliminated roughly half of aggregate Southern wealth overnight. Yet land survived. Southern planters successfully resisted redistribution. Research published in the American Economic Review found that while slaveholders lost 50% to 70% more wealth than comparable non-slaveholders by 1870, their grandsons had fully converged by 1940. The mechanism was not the land's price. It was the land's utility, as collateral, as income, as social proof, and as a platform for recovery. In Tokyo, lots that were literal ash in 1945 became the most valuable ground in Asia within a generation. The modern equivalent is agricultural land with productive capacity. It cannot be emailed across a border, but it cannot be deleted by a keystroke either. Each of these strategies carries real limitations. Gold can be confiscated, it has been. Geographic diversification faces tightening surveillance. Cryptocurrency depends on functioning internet infrastructure. Land can be expropriated, as it was in the Soviet zone of Germany and across Japan's countryside. No single asset is invincible. The families who survived were not the ones who found the perfect hiding place. They were the ones who did not put everything in one. Here is the insight the history books leave out. Every war in history was financed the same way, not primarily by taxes and not primarily by borrowing, but by inflation. The government prints, the currency dilutes, and the people who held that currency discover, always too late, that they were the ones who paid for the war all along. Bonds were not investments. They were instruments of transfer, moving purchasing power from citizens to the war machine, one payroll deduction at a time, and returning it years later in cheaper dollars. The question is not which asset survives a war. It is which assets sit outside the mechanism governments use to pay for one. Every asset on that list, productive equity, physical gold, foreign-held value, land, shares a single property. A government cannot inflate them away by running a printing press. That is not a coincidence. That is the lesson. Thank you for watching. If these historical lessons have changed the way you look at the assets in your own life, please subscribe and like this channel. We are dedicated to uncovering the history that they have tried to bury. Secure your future by understanding the past. The next vault of history will be open soon.